All right, guys, we're going to go ahead and get started. Can everybody hear? All right. We have a microphone. We do this every time. It's not for y'all. It's for the people on Zoom. There's like 110,000 people on Zoom right now. So pretty high traffic. We appreciate you guys for coming out. Change of venue. The AC works here, which is very much appreciated. Who knows? Maybe in winter we'll go back to the bar that doesn't have AC. But for now, here we are. Appreciate y'all coming. We've got a great presentation. We try to give equal time to as much bad news and good news as possible. So this is going to be a very short presentation. We were able to cut a lot of the fun stuff. Got the disclosure here. Basically, don't listen to Ben. Everything he says, just ignore it. We've got a QR code. So if you don't know how to use a QR code, you can take out your phone and you just act like you're taking a picture of that weird pixelated box. And it's going to open up an app where you can ask questions. We're trying a new way for Q&A. We're going to have more time for Q&A at the end. So if you scan that, it'll actually take you to a little website where you can ask questions. Like if I go there right now, you can see questions like Sam Frost asked, am I speaking? And if so, which slides? So you can put stuff in there, and you can also upvote questions. So if there's certain questions that you really want to see asked, hit a like on that, I guess. And with that, I'm going to turn it over to Ben. He's going to get us started. And thank you all for being here. Help yourself during the presentation to drinks, food, whatever it may be.
Thanks, Andrew. I'm just going to let this iPhone in. All right. We titled this presentation High Winds today because those are the seas that we're sailing in right now. They're choppy waters. Today, the VIX for the year has averaged 26, which apart from 2020 is the highest since 2009. 2009, of course, saw a massive decline in the first 3 months of the year. S&P 500 bottomed at 666, and then it took off in the remainder of the year. The average VIX for that year was 29. So we've seen almost as much volatility this year as we did back then. And what the VIX actually shows is not so much the volatility that's already happened, but the implied volatility based on how much are people paying for insurance. So if you've just been hit by a hurricane, you might pay more for insurance because you want to insure against that risk. We're seeing similar things in the volatility index right now as people insure against that. That's just to say, this is the reality that we're operating in. And so that's the context for this presentation. Aristotle Onassis in the 50s, he said that he was a Greek shipping magnate. He said that we must free ourselves of the hope that the sea will ever rest. We must learn to sail in high winds. And ultimately, as business people, as financial managers, as portfolio managers, that's what we're looking to do, is build a ship and be able to operate in choppy waters. The investment landscape, we had this chart on the prior presentation back in July, and it's still operable today. And that is really inflation is driving things. Inflation is driving the Federal Reserve to raise interest rates and put a damper on the economy. The problem is when the Federal Reserve does this, the main mechanism of raising interest rates is simply a code word for increasing the cost of money. When the cost of money goes up, it gradually slows economic growth, starting in markets that are most sensitive to interest rates. Bond markets, stock markets, real estate markets. And that's what we've seen. And then gradually it has impacts into employment and overall economic growth, and therefore inflation. The problem is we're still in this loop. Inflation remains elevated. The economy, as Andrew will discuss in a little bit, has actually stabilized over the last few months. And the Federal Reserve continues to hike rates and, as Tom would argue, is still behind the curve. So the way we operate in this is we don't assume that the sea is going to calm. We don't assume that the sun is necessarily going to come out immediately. We have to operate in this environment, and that means being cautious, being diversified, being sensible on the personal side and in the investment side. So this presentation will take a look at what's going on in the economy, how interest rates are impacting that, how that'll transmit to the market outlook, And then we'll actually talk a little bit about how we're looking at managing portfolios in our business and how we're trying to apply some of these lessons to us as well. Andrew.
Thanks, Ben. So the first thing we want to look at today is really the earnings picture. So we're going to talk about the economy through a bunch of lenses. And I think one that we should not lose sight of is what is actually happening on the home front. So we are seeing a decline in real average hourly earnings. And what that means is essentially on an inflation adjusted basis, people are not experiencing the headline wage growth that you might see in various articles. That's something everybody needs to be cognizant of. If you're at home, you need to understand that, hey, if you just got a 7% raise on your base pay, great, congrats, but that's not necessarily giving you more purchasing power. If you're operating a business, you need to understand that, especially on that lower end of your employment curve, there are people that are struggling. And this is not a new phenomenon. We've been experiencing this on a month-over-month basis since April of 2021. So you can see the zero is about kind of in the bottom third of this chart. If you're looking at the y-axis, we've seen that sequentially. So even when you see a little bit of elevation, say in October of 2021, that's still a decline on a month-over-month basis. Now, at a high level, we are seeing wage growth that roughly is pacing with inflation. But what's interesting about this is consistently, and we've been saying this certainly since 2020, maybe even prior to that, the single biggest winners right now, as it relates to employees making more money, are folks that are switching jobs. But that dotted line is really the overall strategy. And you can see right there, it's under 7%. If you look at just about any headline inflation number, we're looking at numbers north of that. I think we'd be pretty excited to see CPI come in at that level, but we are lagging there. On the broader employment scale, we are seeing some softening as it relates to job openings, but that needs to be taken with a grain of salt. There are so many job openings, and there have been really ever since the initial wave of the COVID pandemic in the spring of 2020, that I would argue some of the data, there's just no way it's accurate. But we have seen a little bit of a decline. The JOLTS job opening report in July said there was almost 11.2 million job openings. In August, we saw a little bit of a lower number at just north of 10 million, but there are a lot of those. And what's interesting is the job postings that we're starting to see evaporate are jobs that rely heavily on work from home. We've speculated on this. It's still too early to make a call, but the work from home portion of the population, they are being viewed, at least as it relates to hiring, not necessarily as it relates to existing hires, but they are somewhat being marginalized as it relates to, hey, I need more people. What do I want? There's been a little bit of a shift towards folks that are actually going to come into the office. And another way to look at this is hiring intentions, which are falling. So if you look at this bottom row here, this is a survey that asks, do you plan on expanding or reducing headcount? We're looking at the second quarter of 2022 versus the third quarter. So just 1 quarter of movement there. Previously, about half of the company said they were going to add to headcount. Only 11% said that they were going to cut. We're now looking at less than half saying they're going to add, and we're looking at 19% saying, hey, we're looking at reducing our job force. And this is across the board. Now, that should not be viewed as a one-to-one scale. Not every single company is structured the same. We may say, hey, we want to increase headcount, and that means we want 2 people. And Microsoft may say we want to cut headcount, and that means 10,000. So those are not necessarily one-to-one, but we are starting to see early signs of some reduction in the workforce as it relates to hiring. But we have seen stabilization. This is not a sharp, pronounced trend. If you look at these charts, you can see this is Atlanta over on your left as you're looking at the screen, the United States at large. These things largely mirror each other. But if you look at that orange line, which is current year, there was a sharp drop off this summer. Economic data got bad. People thought for whatever reason that CPI and an inflation story was going to be a little bit better than it was. They probably expected that it was going to be a lot better if they listened to the Fed, and Tom's going to talk about that at length. But that economic data was pretty jarring, and people pretty quickly said, hey, let's cut back on the hiring. There was lots of big companies that announced, hey, hiring freezes, no more hiring. We have seen a bit of recovery from that level, and that may sound good, and that is good if you're looking for a job. But as it relates to what the Fed is trying to accomplish, and Tom will talk more about this in a little bit, that's not necessarily a good thing.
Yeah, we're in a good news is bad news scenario when you're thinking about the Federal Reserve, because the good economic data that we have transmits into higher inflation numbers. And you can see that here. When people started cutting jobs, that green line is that core inflation. So that strips out food prices, it strips out energy prices, and that's really that sticky price inflation that we don't want to see, and the Fed doesn't want to see. And it did begin to pull back a little bit when those job cuts were going on. But as things stabilized over the last 3 months, core inflation has ticked up again, which sets the stage for more Fed rate hikes. And this is not just a year-over-year phenomenon. This is actually happening month over month. So again, the green line here shows that inflation in the month of September compared to inflation in prices in the month of September compared to prices in the month of August were up 0.5%. That may not seem like a lot, but that happens month after month after month. And you're talking about over 6% annualized inflation, which is triple what the Federal Reserve wants to see, which means that they're going to continue to be on the brake and continue to have to raise their estimates of what inflation is, and as well as interest rates as well, because they have not been right so far this year.
Yeah, if I could really illustrate the ineffectual nature of the Fed for 1 year, is that they have a bit of a credibility conundrum. So if you look on the left-hand side of this chart, you can see at the end of last year, the Fed thought we're going to have 4% growth. We're going to raise interest rates, if you look in that bottom left corner, somewhere between 3 and 4 times. And that was going to bring inflation all the way down to kind of that 2.5%, 3% range. If you look now, September 2022 estimates, they think that GDP is essentially going to be zero. And inflation is going to come down to about 5%. And you look down here in the bottom corner, the biggest driver of markets this year is that they estimate that they need to raise the federal funds rate to 14.4%, which means 18 total hikes between 17 and 18, but leaning towards 18 at 4.4%. So we have a bit of a conundrum here, because right now GDP now for Q3 has been upgraded to 2.9%. So now we're way low on GDP, we're way high on unemployment, and we're way behind the 8 ball in terms of the number of rate hikes that were estimated for the year. And that's what's causing all these gyrations. So interest rates have risen extraordinarily rapidly. So if you're looking at what we call a shock analysis on a bond, the first step would be, what would it look like if interest rates went up by 1%? And an extreme case would be, what would the price of a bond look like? It went up 300 basis points or 3%. Right now we're at 2.5, and that's happened in 9 months. So it's been one of the most rapid rises in interest rates in the history. And the last couple of weeks, we saw a massive spike on the 10-year. You can see sort of towards the tail end there, which was the fastest we'd ever seen them move up to 4% in history. So interest rates are really, really moving. And that's really causing, the market to be reevaluated in terms of, what are the cash flows on businesses, what are the cash flows on bonds, and where do we need to be in terms of settling on interest rates. And mortgage rates have risen even faster. If you were at our last presentation, there was a question in the Q&A, which was, how high do we think interest rates are going to go on mortgages? And I thought I was being kind of contrarian by saying I thought we could get to 6% by the end of the year. And we crossed over 7% for the first time since 2008, just in the last week. And so we've seen just massive upshift in what it costs to borrow on a house. And there's a number of reasons for that. And the first is being structural. If you have a mortgage and you're paying 5% and you own that bond in your account, you have extension risk, which is to say, if we go to 7%, no one's going to want to buy your mortgage. They don't want to get paid 5%. If you're in that house, you don't want to pay it off early, because your options are, redeploy that into a down market or turn around and refinance into a higher interest rate. So a bond that typically would be 5 to 7 years, if someone either pays down their mortgage or moves or sells their house, people are getting stuck in their homes. And as a result, these are becoming assets that people don't want to hold. On top of that, the Fed is running off their balance sheet, which means they're no longer actively buying mortgages in order to keep these rates low. And so a massive buyer in this market has exited. And then the third piece is banks don't want to hold them either. It's a massive use of their cash. They want to offload them as quickly as possible, and they don't want to get stuck in holding the ones with 5 and 6% coupons when 7s are coming out the next month. And so demand has dropped precipitously, as well as supply. But the fact of the matter is, nobody wants these assets. And as a result, liquidity has dropped to essentially zero in the mortgage market. And the less liquidity there is in a market, the wider you have on spreads, which is essentially to say, if nobody's buying, the price continues to drop and drop and drop, and the rate on those assets continues to go higher and higher and higher. So I think that we're going to continue to see this, but I think that from an opportunistic standpoint, there's going to be a time where filing into mortgage-backed securities, either ahead of a pivot on the Fed, either in stopping the run up on the balance sheet or cutting rates, or a potential economic downturn, you can have some exceptional returns on mortgage-backs. For right now, we're just seeing mortgage spreads just explode, and it's a little bit of a hot button issue in terms of slowing the economy, how much it costs to buy a house, and we've seen it move at a historically fast rate.
Thanks, Tom. And I think from the view of the Fed, we are looking further out and wondering when they're going to change behavior, but we're already seeing human behavior start to shift as it relates to a lot of this stuff. The Walmart CEO came out and basically said, hey, this whole market of shoppers that we historically, or at least lately, have not had access to, they're now shopping at our stores. Kind of that middle and upper tier income folks, they're coming into Walmart. At the same time, they're not necessarily losing their lower income shoppers because they're still a viable, low cost provider of a lot of goods. And so we are seeing companies that stand to benefit from that. Costco is another example. We'll talk more about them in a little bit, but we're seeing people really change their decision-making process as it relates to homes. They're looking at affordability. A couple macros ago, we gave the example of interest rates starting to tick up. I think this was the April macro presentation that we did. Prices being higher. And we gave the example of several folks in our office that bought homes between 2018 and 2020. And it was like, look, we probably wouldn't buy our current home at its current price and with a higher interest rate. Well, prices haven't really come down, and I'll touch on that in a moment, but interest rates have gone up significantly. And so we're now looking at situations in which people are either A, able to buy a lot less home than they thought they could, or B, they're saying, you know what, never mind. Now, some of that is absolutely sticker shock, and I would almost argue that it's prolonged sticker shock. The Lennar Homes team, they use the term sticker shock. I would argue that some of it is people that are younger. They're looking at buying their first home, or maybe they're upgrading from a starter home, a condo, townhome, something like that. And they've just always had the world view that interest rates are going to be in the 3% range, maybe even lower. Some of that will wear off and they will re-enter the market, but we are seeing some changes there. We talk about the causes of this inflation. So much of it was the stimulus and the money that came into the system in 2020. But I would also argue that's a big part of why this current economic situation is not worse right now for the average American household. We have seen some real peaks in savings. We talked about this at length, and we have been for the last year and a half, but at the end of 2020, the American household had more money in savings than they'd ever had. Debt was low. They actually made more money in 2020 than they did in 2019. And that was the case significantly. Because of that, they saved a lot of money. And so you can see that first big peak is in 2020. You saw a little bit of a peak in 2021. And then we kind of came off the cliff. Two things I would point out. One, off the cliff is really back to where we had been historically, but we're also seeing a little bit of stabilization over here on the far end period. If we look at Q3, there is a little bit of uptick. And a lot of that is driven by news cycles and economic headlines that are saying, hey, things might get bad. People are probably going to lose their jobs. Did you hear this company's no longer hiring? That might be a bit of a warning sign. Maybe we should put some money back into the savings account. So people are acting right now somewhat responsibly. You see it on people sitting back and not buying a home they can't afford. You can see it with more shoppers going to Walmart. You can also see it here that we have seen credit card debt increase. Again, seems like a big amount, but not necessarily a huge skew relative to some of the numbers that we've seen back near the global financial crisis. But we've also, again, here seen a little bit of a downtick. When people compare this to what we saw in 2008, let's see if we can do this. Where's my mouse? Welcome, Jeff. When we talk about this being just like 2008 or 2009, I mean, my personal theory is that people associate economic hardship with their biggest economic trauma. We've got a lot of young folks whose only exposure to a down market has been the brief period of COVID in March of 2020, and then it rocketed up. So in their mind, they're like, why on earth is this happening so long? A lot of our older clients really weren't all that bothered by the COVID issues in 2020. They felt like, hey, this is overblown. This is nothing like the systemic issue we had in 2008. But now they're saying, oh, this must be like 2008. On the consumer side, credit card debt remains relatively low and remains somewhat sold out, and we're seeing a little bit of a decline. And there's no better chart to illustrate that than credit card delinquency rates. We are as low essentially as we've ever been. This is a very different economic picture of the American household than what we were seeing in 2008 and 2009. And you can see that with that huge mountain. That wasn't a one-time spike. It's very different. If we go back 2 charts, it's very different than the quick spike in personal savings. This is pretty prolonged. I mean, this stretched for multiple years in which families really had a hard time getting out of that, and they remained delinquent for a prolonged period. So we're on a relatively stable ground right now as it relates to the American household. If we were not, we'd be in a much bigger problem.
I think the big thing that we're watching right now is obviously inflation. And the reason is lower inflation would give us an out. It would help slow the Federal Reserve's rate hikes and quell financial market fears. And we thought we were getting there a little bit in the summer. And one of the reasons was oil supply increased. OPEC increased supply, had been increasing supply for a year and continued to increase supply. And then we also had these releases from the Strategic Petroleum Reserve. And as you can see on the chart on the right, we released a lot of oil, 1 million barrels per day. Over the last 6 months have been released from the Strategic Petroleum Reserve. That is going to continue through the end of the month. The concern going forward is that that was a temporary phenomenon, because we're now beginning to see that reverse. We're now beginning to see oil supplies begin to fall. OPEC Plus has just announced a 2 million barrel per day cut. The SPR releases are just going to be 10 million barrels in the month of November, so about 300,000 barrels per day. And so we're seeing a decline in oil supply beginning in November, which could serve to increase oil prices again. And it does seem that OPEC is keying on that $100 per barrel mark as a floor for the price that they want. And currently we're about $90 a barrel. Also going to talk a little bit about European policy and US policy. So on the European side, they have a very tough situation right now because their big energy supplier is gas. That's their big source of energy. And right now gas prices are through the roof, which makes it very tough to heat your homes in the winter. And so the way that these governments are combating this is they're putting price caps on natural gas. The problem is basic economics say you put a price cap on something, people are going to want to consume more of that good because the market, you're disrupting the market mechanism. So it is tantamount to fiscal stimulus. And when you have inflation, sky high inflation already, and you put fiscal stimulus on top of that, you could perpetuate that inflationary cycle. But the politically popular thing is we don't want people freezing to death in the winter. So UK policy is they're announcing a big fiscal stimulus plan that's going to take effect. That's going to be announced on October 31st. We just saw the prime minister leadership change from Boris Johnson to Liz Truss. Germany is coming out with a 300 billion euro package to cap the price of natural gas. And then Italy, you're seeing some political changes as a result of all this. The furthest right government since World War II just took office, led by Giorgia Meloni. She's toned down some of her rhetoric in the last number of months, and she still has to put a coalition together. But that's something to watch going forward, is that as the economy hurts people, we're going to see some political shifts. We've already seen 2 big ones in the UK and in Italy, and I wouldn't be surprised to see some more going forward. On the US side, we obviously had the Inflation Reduction Act that took place this last quarter. There really isn't a ton consequential here. I think it's probably quite good for the utility companies who are going to be incentivized through a number of tax credits, both on the production tax credit and the investment tax credit, which is a new thing for them. Pharmaceutical companies could be harmed a little bit at the margin by Medicare's ability to negotiate certain drug prices, but there really isn't a ton there in terms of reducing inflation, especially in the near term. And as far as deficit reduction goes, deficit reduction typically is deflationary because the government spending less. But the problem is in the near term, the government's actually going to be spending more. The deficit reduction really happens in 2027 and beyond. Thank you. Hey, Peter. The deficit reduction really happens in 2027 and beyond. And we all know that in politics, 2027 is light years away. And I would be shocked if we actually were reducing the deficit by these amounts in those years. So I don't think the Inflation Reduction Act will reduce inflation that much at the margin in the near term, and probably not in the long term either. And finally, we had the student loans piece. Three big things to the student loans piece are student loan payments are resuming in January, but they're going to be capped at 5% of discretionary income. So it's not going to be that much of a reduction in people's take-home pay. And then you also have the loan forgiveness piece. The loan forgiveness applies to $125,000 if you're single, $250,000 if you're married. We all pretty much know the details. The jury's out on whether this is inflationary or deflationary, and basically it all comes down to, have people been saving and putting this money away for the last 2 or 3 years? I don't think they have, in which case they're going to have to start making payments again, and it's probably going to be maybe even deflationary at the margin, but it really isn't going to have that much of an effect, I don't think. It's a windfall for these people who have this forgiveness, but again, they haven't been making payments for the last 2 years anyway. Moving on to the economy side, I think it's notable that the orange line there is inventory in the services sector. The way that they account for this is they put retailers on the services side, which means retail inventory has actually fallen over the last couple months. Retail inventory being high was one of the big drivers of inflation coming down over the summer. Target had too much inventory, had too much patio inventory. A lot of retailers had too much apparel inventory. They marked those down. Well, those markdowns might be going away now that inventory is more normal. And fixed investment is falling. These are expectations for fixed investment by CEOs in the US. It's falling, but it's not dramatically low. And I think that this could continue to come down. CEOs right now are continuing to invest, but we don't have that same fear that we had in 2008, for instance. On the residential investment side too, that's where we're seeing a lot of the slowdown in investment.
Yeah, we're seeing a slowdown, but I want to be really clear. Again, I mentioned kind of the financial trauma and how people associate it with it. We do not expect, speaking for the firm, we do not expect a 2008 like housing crisis. That is not where we are, but we are seeing a slowdown. Mortgage payments for new mortgages on similar purchase prices have essentially gone up 50% year over year. Sam didn't trust this slide, so he ran it himself. If you set out in goals, you were goal seeking to a specific mortgage that you could pick up, and you said, you know what, I can buy a $450,000 house at 3%. You could do that with that same monthly payment in the environment that we're in now. You're looking at $300,000 purchase price, and that can be a problem for real estate, especially as it relates to inventory. We're still underbuilt. That's the positive. It's kind of this weird bad news is good news is bad news thing. But we're still underbuilt. And because of that, although we're seeing a pullback in housing, we're not necessarily anticipating a massive crash in real estate values. Median sale prices have stabilized essentially over the last month. We saw a little bit of a dip, and then we saw some stabilization. But homes still are selling above their listing price. The biggest difference between a year ago is the people buying homes right now, they're actually going into them. They're looking at them. They're seeing them. They're actually using a real estate agent that shows them multiple homes. It's very different than a year ago where you could list your house for some fantastical value, sell it for 10% above asking, and never have a showing because somebody from New York bought it. So we are seeing a difference there, but we're not necessarily seeing a huge drop. The homes that do sit for a while, and this is where it kind of gets back to a more normal real estate cycle, the homes that do sit for a while, they are having to drop the houses price. That's what we're seeing consistently. So it really comes down to the area you're in, what you're looking for. But there's still really not a whole lot of inventory. I'll pass it back. I think that Ben's back up here.
Yeah, I think the big theme here is that we were in the eye of the hurricane maybe in Q3. There was some stabilization, inflation came down a little bit. Consumers were able to breathe for the first time in a few months. And the chart on the left, the light blue shaded line shows that they started buying again and actually growing. Costco sales actually picked up a little bit. But it's a mixed bag. On one side, on that left-hand side, we'd be concerned that inflation may be starting to pick up again, whether you're looking at retail, they have inventories more in line, whether you're looking at lower oil supplies, higher oil price. So that's hurting, that could hurt consumers on the cost side. And then consumers could also get hit on the income side because we've reduced job openings at the margin and because the Fed continues its aggressive policy. And ultimately, that's where we're getting to in terms of the stock market. This slide is a little bit technical. If anyone wants the technical rationale or intuition behind it, we can talk about that. But the basic concept here is that higher numbers mean stocks are cheap, lower numbers mean stocks are expensive. And this goes all the way back to the 70s. And what we've seen is that over the past 10 years, since the global financial crisis, by looking at this and using this as a way to measure stock prices and using interest rates to do so, you can actually get a fairly stable level of where the fair value of the stock market is. The problem is the base of this is the interest rate. So the interest rate is indexed to stock prices in this chart, and interest rates are rising. The brown line here shows the 10-year interest rate. The dotted blue line shows expectations of inflation. And you can see that those are correlated dramatically. And so the flow chart is inflation up, interest rates up, stock valuations down. And the primary driver of this is the reason that interest rates are rising is the Federal Reserve. Low values mean that the Fed is very easy, that they are reducing the cost of money. When the cost of money is low, it means people want to invest because they want to deploy that capital. When the cost of money is high, you want to keep that money. The value of it is very high. And so instead of deploying that capital right now, people are really holding on to it tightly. And this is driving lower prices on bonds and higher interest rates. Furthermore, fewer dollars available because the value of that money is so high, you're starting to see stock prices, stock valuations fall. So that's the red line, and stock valuations have really come back. A lot of that froth has been taken out that existed in 2020 and 21. And now we're back to more normal valuation levels. So the conclusion here is that Fed policy has driven most of the stock market and bond market volatility to date. They've taken a lot of the froth out of the financial markets. And the next step would be for that to transmit into the underlying economy. And we're kind of in that eye of the storm, so to speak, where we've transitioned from the Fed really taking down valuations. And now we have to see, can they take down inflation without really hurting the economy to a more meaningful extent? Which leads us to, how do you actually manage in this market? And ultimately, you need to have a strong ship and be able to be built for those choppy waters. Having a really fast, light ship is not the one that you want in this market. You're not hoping that all of a sudden a favorable wind's gonna blow, seas are gonna come. You're running with the assumption that the waters are going to be choppy. And so ultimately, we don't have clairvoyance into what's going to happen on the macro side. That's even less in volatile markets. And I think that most rational people would agree with that statement. Risks do appear a little bit skewed to the downside because of what we've already talked about. But there are risks to the upside as well. If inflation comes down, then the Federal Reserve will take its foot off the brake and allow the economy to function a little bit more. So what we're doing is we're making 5 areas of emphasis. The first one is to have self-amortizing assets. This basically means that you own a stock, you own a bond, you own something that pays you income and that gives you cash. That cash can be redeployed at potentially lower valuations, and it gives you liquidity in an environment where liquidity is scarce. So that's really important, having a self-amortizing asset. You have little or no reliance on financial markets. You don't need to roll a lot of debt. You don't need to access equity markets. You don't need to go out and find venture capital. Those are places where we want to avoid. You have a reliable revenue stream. I think we all kind of get that. And you have significant returns on invested capital. We want companies that can return 20% on invested capital, not 10%. Because if interest rates go up, your borrowing costs might be above 10%. So you need those high returns on invested capital. And ideally, we'd have some sort of idiosyncratic opportunity as well, where we might have an edge on a company that can perform. There's something going on there that's different than the overall market environment. Tom's going to present one. I'm going to present a couple, and Jason, an analyst who's been with us for almost 3 years now, is going to present one as well. So, Tom.
So this is an example of a bond that checks all the boxes in terms of what we're looking at and the criteria that Ben laid out. So these would be the HCA's 5 7/8 2026. So HCA is a large publicly traded hospital company. And we actually pitched these bonds about 2 years ago. Jason did the pitch on them. And at the time, we decided that given the interest rate landscape, these are going to be just too expensive at the time, but they were clean and we liked them. And we're just going to file it away for a better day. And now is that day. So any of you guys have been here for the last 4 or 5 macros, we've talked about how we have avoided investment grade corporates like the plague for years because the risk reward ratio there was flipped in the opposite way we want it to be. And with interest rates rising, those who are holding have gotten really hurt, but those who are looking to buy are looking at a great opportunity. HCA is a great example of that because they've got a super high coupon. If interest rates on, say, in 2026 on the interpolated yield curve is looking at like 4.2%, if we can get 6%, we've got a great buffer in terms of yield between where the treasuries are, where they could go, and what we're getting paid. In terms of amortization, they're paying a very high coupon, which means we're getting our money back faster. Each time we get paid a coupon, the cost of our bond goes down, and eventually we're going to get par back. They're not looking to raise additional debt. So as interest rates rise, they're not looking to say, hey, we need to get more money, and they're going to have to pay higher rates within the bond market by issuing new debt. And so we feel very comfortable that they're not going to have to get penalized for accessing the capital markets. Very clean balance sheets. They're getting better. And then the idiosyncratic piece is that, during the pandemic, they had trouble with staffing and having to pay up for all these nurses, trying to find people to work in the hospitals, overcrowding. They had to avoid, private surgeries because they needed the beds for COVID. Well, all of that is kind of wrapping up. They're now finding that they're finding it easier to staff, lower wages, everything, all those costs are coming down. And so they're getting hardier as the economy in general is getting a little bit unstable. And so we think this is an excellent opportunity, checks all those boxes, and it's the kind of bond that we're looking for right now in terms of the current rate environment.
Yeah, Jason did a lot of work on the equity side on HCA. And this is one where we just continued to look down the capital stack, and eventually the bonds looked attractive. Costco, the equity looks good to us as well. And the reason is they tick all those boxes that we just talked about. They pay a dividend. They may pay a large special dividend this year. They've talked about doing it in the next 6 to 12 months. And that allows customers, shareholders to have that added liquidity to the portfolio. They own predominantly all of their warehouses and their assets, which means that they are not subject to a landlord. They have excess cash on their balance sheet. They have very low debt. Their cash exceeds the debt, which is why they can go ahead and pay a large special dividend. Membership revenue is a huge piece of their business, especially on the operating income side. And we're looking for that special dividend potentially to help out, and also a membership fee increase. I think that we're due for one, and they happen every 5.5 years, which would happen this December. So we'll see what happens there. They may look at the macro environment and say, we have to help our members out a little bit, and we'll forestall the membership fee increase for now, but that's coming. So if you're a Costco member, you might want to renew sooner rather than later, but it'll probably be about $10 a month. But for them, it's a big piece of their operating income. Jason.
So Eli Lilly is a pharmaceutical company. They're based out of Indiana. On this self-amortizing piece of things, they pay a pretty good dividend. It's about 1.2%. So you'll get that much of your money back, about average in the industry. Something that's very different from them, from some of their competitors, which you might have heard of, like Pfizer or Merck, are that they do almost all of their development in-house. So Pfizer is going to go out and they're going to go to the M&A market and buy existing drugs that other companies or smaller research labs have started. Lilly's going to do all of that in-house, which leads to lower costs for them. On the revenue side, the reason that everyone hates their pharmaceutical companies is why Lilly is such an attractive investment here. If you have a medicine that you have to take for your health, you don't really have a choice. They're going to get the revenue really no matter where the economy is. In terms of returns on invested capital, they have an advantage over their peers for the same reason that they aren't as reliant on the M&A market. So when they hit a home run, they really hit a home run, versus Pfizer just paid over $6 billion for a company with zero in revenue that they're hoping maybe gets to 200 million in revenue a year. Lilly would maybe pay, 50 million to get that same revenue. And then lastly, they have a couple new drugs in their pipeline. Manjaro is probably the most exciting one. This is a diabetes medicine. They're one of the leaders in diabetes. And during the trials to test it for diabetes, they found that it results in an over 20% loss in weight. So they are now trying to fast track that through the FDA to get it approved for weight loss for obese and overweight people. It's an weekly injection, and you don't really have to exercise with it. You don't have to change your diet, and you'll lose 20% of your body weight. So we think that could be a huge opportunity if they get that approval. And then also they have an Alzheimer's drug. So some of you may have seen a couple weeks ago that Biogen recently got approval for an Alzheimer's drug that initially the market thought was not going to be approved. And Lilly has a competitive drug. So initially we weren't really pricing that in as an opportunity, but now we think there might be some additional upside there.
Thanks, Jason. For the record, Jason just did a phenomenal job of distilling a 34-page pitch into about 120 seconds of content. So well done. The Manjaro thing is extremely interesting to us. We've talked to a number of doctors who are already prescribing it off label, because it's only labeled for diabetes. And if you go onto some of the forums, people are saying this is the greatest thing since sliced bread. So it's a very interesting proposition for us. And then finally, Cisco Systems, the company pays about a 3.7% dividend. And importantly, they provide a lot of the technology, the infrastructure for companies that just have to upgrade their infrastructure. They're in the midst of a strategic shift to more recurring revenue. They're actually managed by a guy who grew up just outside Atlanta. He's an engineer by trade. He's not a business guy. And his conference calls are probably some of the most boring conference calls because it's like reading an engineering thesis. But it's a well-managed company, and they pay their shareholders a good bit too. So with that, I'll let Andrew take us home.
So wrapping it up, just kind of firm update on everything going on. Harrison Pettigrew. Harrison, stand up, man. Yeah. Harrison was brought on. He started September 1st, I believe. He's a junior portfolio manager. We're excited to have him. We poached him from a smaller firm here in Atlanta. He is a Georgia Tech alum. Knew a lot of the folks we know from our internship program at Georgia Tech. We got a couple. Where's Sagar? Sagar's here. We didn't invite Reagan because he's not professional, but if you've been here before, we usually have kind of a nice stable of 1, 2, sometimes even 3 interns from Georgia Tech. We're really grateful for all the work those guys do. Really thankful for them. Lately, we have had some changes in terms of the communication. Hopefully, you guys have been getting the market memos. Those go out every Friday at 3 p.m. Sometimes 3:30, but we do our best. Sometimes it takes us a while to figure out a good quote for the top of that. That's the hardest part. But that really came from a client. A client said, "Hey, love what you're doing. Fine with it, comfortable with what you're doing, but I'd like to hear a little more just week to week." And we said, "Hey, if we're going to write it for him, let's send it to everybody." So if you guys ever have ideas or suggestions on ways that you would like to personally consume information or analysis or what's going on in your portfolio, please let us know. If you like it, there's a good chance that somebody else likes it. We're still doing the morning calls every morning, 8:30 a.m. We'll be back tomorrow. We took today off. But every morning it's also on, where all is that, Luke? YouTube, Spotify, Apple, yeah, anywhere you can listen to stuff. So check that out. Tom and I have been speaking at a couple conferences, just trying to spread the word on how, what we do, why we do it, all that good stuff. It's been a rough year. We understand that, and the year's not even over. That's the good/bad news. I don't know. But we're really grateful for the team we have here. Thankful for everybody's work. I mean, you guys know Ben, he does a lot here. If you think Ben's good at investments, you should see his family life. So Ben, we thought, got married in Scotland on the 21st of September. I remembered. So Ben got married, we thought, and then he liked it so much that 17 days later, he decided to make it official and got married in the US. So Ben's married now, which is a great, exciting thing. Tom's having a baby, his wife's having a baby rather. Natalie, who some of y'all know, that really keeps all of us in line. Also expecting, really grateful for her. Jonathan Hicks, probably the most underrated guy in the company. Yeah, he is single and unattached, allegedly. But Jonathan does a great job running compliance, running performance reporting, all of that good stuff. Sam Frost, most of y'all know, doing excellent work on the analysis, helping out a lot with the younger guys, helping them understand our investment process, what's going on, managing portfolios. Melissa in financial planning, Melissa's kind of over in the back middle table. If you have not talked to Melissa, please talk with her. She's been really helpful. Luke doing great stuff on the 401k side, as well as the client relationship management. Jason got a little shine earlier. Mo, shout out to Mo, best bang for our buck of any employee we have. We don't pay him, but he's a Georgia Bulldog. He's a student. If you know Georgia Bulldogs, they're selfless. They're not in it for the shine. He said, "Don't even pay me," but he's doing excellent work. We're really grateful for all that he's doing there. And John Grayson, who runs kind of the client support, client account exec, whatever his title is, just invaluable. We're really grateful for our team. We're looking to get John some help on the client service side. So we'll probably make a hire that we will probably announce at the next macro. But just super grateful for the team, super grateful for the clients we have. It is a challenging environment, and I understand that it is frustrating when we say it doesn't look good, we're staying the course, staying disciplined. The reason we are saying that is we really believe that a big part of what we are being paid to do is to bring discipline. So if we push back on going all cash, a lot of that is because most of the time when people go all cash, the market rallies right after that. We're trying to stay disciplined. We're trying to really hone in our process, but there is absolutely nuance in what we're doing. There are absolutely changes in how we're positioning portfolios. I think Ben did a great job of kind of highlighting what we're looking for from the investment landscape. So we appreciate you guys. John is going to hit us with Q&A. So Tom and Ben, if you want to come up, we can kind of pick these apart. We'll see if we have any questions.
Yes, so the first question on the app, and if you guys have any more questions, feel free to scan the QR code and shoot them there. But the first one is, how do I sign up for Manjaro?
That was my question.
The second question is, when does good news stop becoming bad news?
Ultimately, it requires inflation getting back to probably 2.5% to 3%. I think once we're on a downward trend, a clear downward trend, when we're going from 6 to 5, I think that people get a little bit more confident. But right now, it's gonna be some time, or the Federal Reserve will have to shift back. But I don't see them doing that.
I do think there's some nuance to that. This just remind you, you know, a couple months ago, if the market was down 2.5%, everything was down 2.5%. We've had some days lately. Costco does a great job. We really like their management team because they post sales data every month. Last week, there was a day in which the market was down and Costco significantly outperformed the market because their sales data was good. We are starting to see, maybe the word for it is just discernment from market participants, where everything is not necessarily being all lumped together. That's a good thing. It means people are actually kind of dipping their toes into the water, thinking about what's the latest news and not just assuming it's negative. I think that's a relatively positive sign. Certainly doesn't mean that, hey, we're going to rally because Costco had 1 month of good sales and everybody likes the data, but it is good to see a little bit of nuance and differing flavor there.
I think from my perspective, if you look back at the taper tantrum, the original time the Fed tried to unwind quantitative easing between 2013 and 15, it was a very similar period where everyone was watching the Fed. Everybody wanted to know what they were going to do. When are they going to taper? When are they going to stop quantitative easing? And we got in this good news and bad news cycle. But there was a period where eventually they stopped televising the meetings. It stopped being front page news. And it takes just a little bit of really honestly people getting tired of watching the Fed. And so by the 2016 period, there was really about 2.5 years where no one was paying any attention to what the Fed was doing. Then we maybe overshot it by hiking too much in late 2018, and the markets had quite a tumble there for about a month. But eventually people will stop focusing so much on the Fed. I think at that point, it's probably once they stop hiking, if we have a couple of months where there's no real news coming out of it. But it's very similar to that 2013 to 2015 period where everyone was paying attention to the Fed, which most people don't do most of the time.
Yeah, it's super boring. That's why we hired Tom just so we didn't have to. And for the first time in almost 4 years, Tom's worth something. So
So the next question is, if people are making less and paying more because of inflation, how are they making ends meet? Credit cards, question mark? I don't understand why delinquencies are so low.
I think people are making conscious decisions to spend less. We've seen a number of more consumer facing companies, even Apple, saying, hey, we're going to cut production on the iPhone moving forward, at least for the next 12 months, because demand is a little bit lower. Interestingly to that, and I think maybe this is supportive of kind of the breakdown economically, demand for the higher end iPhones is very, very high. They're having no problem with the 14 Pro. It's the lower grade model. People that maybe could not afford that iPhone even on a monthly basis, they are saying, hey, let's take a pause. So I think it's really coming down to personal consumption. I think we will start to see things like travel probably start to subside a little bit more. We're going to see a little bit less discretionary spending. But even looking back at the last quarter, part of it comes down to the inventory side. There was too much inventory. If there's too much inventory and they want to move it, they cut prices. Now something that would have organically been unaffordable suddenly looks somewhat attractive, and they say, hey, I'll buy that.
Yeah, I would say oil prices were down 33%.
It's a big chunk.
So that's a big tax cut for people. And all of a sudden they had just a little bit of breathing room. It was back to school season. They started to purchase a little bit more there. I think that also as we move through time, the variance between those two, how much people are making and how much costs are going up, is still very nuanced on a month-to-month basis. You look at the bigger picture, and I think that that's true, that it's hurting overall demand. But on a month-to-month, you'll see movements, and I think that's what we saw in Q3. And so the hope is that we can get costs down and keep those wages up, and then maybe the wages start to normalize a little bit. But I would just say, it's a matter of timing. Is a piece there too.
I was just gonna say, as someone who was very much participating in that big delinquency hump back in 2008, 2010, you can hold it off for a while. I mean, you can make the minimum payments for a long time, and then eventually you get caught up at the teeth of it. So there's a reason why that was a 2-year period, is because, someone who graduated in 09, like, I had a sweet internship at SunTrust, and then that went away, and then I worked at Starbucks, and you're not really making ends meet, but then after a while, it erodes, and then eventually you become delinquent. So it takes longer than you think. You can hold it off for a while, is my read on it.
Pulling back the curtain.
I'm just saying.
That's the other reason we hired him. One, nobody wants to pay attention to the Fed. Two, this guy needs a job.
I know more about the
Well, one other last point on that, John, and that is when a lot of those savings were being eroded in Q2, people were buying their summer travel. They were buying their plane tickets, they were buying their hotels, booking their rental cars. They're not doing that so much. And so they are able to save some money by not doing that. And that all gets seasonally adjusted out of the data. So their vagaries with the seasonal adjustment.
So the next question, Tom, I think this one for you probably. It reads Putin or Powell, which is more destructive, most rational in their irrational behavior.
I think in terms of like degree of suffering, Putin is probably more.
Jay Powell won't kill you.
Why? Like if you live in Ukraine, Putin is really hurting you a lot. And in Europe as well. But I think that one thing that's lost, and we touched this on this a little bit in the call, is that the Fed mandate doesn't have any regard for other countries. And the Fed is going to continue to raise rates in order to satisfy their mandate, which is US price stability and US employment. So I think there's a lot of that talk going on this week. There's a number of international meetings, the IMF, the World Bank, things like that, where I think he's catching a lot of pressure to not raise rates to the degree that he is. And we're seeing, I mean, we saw trouble in Italy early on. We saw trouble in Japan early on. Bank of England is now really worried about their situation. But at the end of the day, you got to look out for number one. You know, all these countries are going to look out for themselves. They're not looking out for us. So I think on a low grade scale, it's possible that Putin could cause more economic hardship for more people as a result of his actions. But I think that there's a lot less malice. Whereas I think that Putin obviously is causing problems, but the degree to which problems are widespread, I think is a lot smaller, honestly.
Yeah, but we did the deep dive on sanctions. Is that last quarter? Probably, or maybe 2 quarters ago. I mean, the reality is economically, I mean, if you see anything related to Putin as it relates to the immediate economic impact in the US, I mean, you could drill in and you could write a textbook about what the impact actually is, and maybe there'd be some value there. The reality is, as we said at the very beginning, the market, the economy, the employment picture, all of this right here in the US is being driven by inflation and the Fed's response to it, and they've been too slow.
Yeah, I would say Powell is being exactly rational now, but
He took a
very
long time.
late. And arguably he's still not thinking right.
Got 2 more questions. This is a 2-parter. What assets outperform in a rising interest rate environment? And then within stocks, do value stocks or growth stocks historically outperform in a rising interest rate environment?
So on the fixed income portion, I'll defer to Tom, but I'll steal a little bit.
Spoiler alert.
Say floating rate bonds.
Which he's been talking about for a year.
Yeah, listen, we were going hard in the floating rate bonds, but it was not cool. And they're the only thing that's up this year.
I would say on that too, there are a couple of risks when you're looking at interest on owning fixed income. One is just the mark to market, what they call interest rate risk. But 2 is reinvestment risk. If you're not getting income or that's not rolling off, you're not able to reinvest at a higher rate. And so that's where it's not a single bond, but a portfolio strategy where you have that ladder lined out so that you can have those bonds roll off and reinvest at higher interest rates. On the stock side, value stocks tend to perform better in rising interest rate environments. Like this in inflationary environments. And I think there's an important nuance in that. Is it being driven by inflation or is it being driven by a steady rise from the Federal Reserve? But value stocks tend to perform a little bit better, which is one of the reasons we're focused on companies like Cisco or Costco or these companies that generate cash.
Yeah, even more simplistically, if your business model is dependent on raising capital in this environment, you are going to struggle if you're a publicly traded company. And right now, that's really impacting publicly traded companies. That is going to start trickling down to privately held companies, some of the private equity stuff. That's going to have an impact on Ben touched on it, and I know Tom has a great rant, so I'm just going to steal it from him because I want to talk. But this is the single best time, in our view, to be buying individual municipal bonds as opposed to buying a mutual fund or something that just holds a collection of bonds and pays you X%. You will get that yield. You will never get your capital back unless you say, hey, I want to sell some. And when you sell that, what's going to happen is they're going to sell bonds. And when they sell bonds, they're going to take whatever price they can get because we've got a big buyer, the Fed, that's stepping out of it. And when that mutual fund sells bonds, Narwhal loves it because we'll bid real cheap on that stuff and pick it up for clients that want to own individual bonds. So, I mean, really, it's an excellent time to be building fixed income. It's an excellent time to have an existing fixed income portfolio that has been appropriately laddered and has money coming due on an ongoing basis so that you can redeploy at higher rates as opposed to just owning this big amalgamation of bonds.
Yeah, I don't argue. I mean, it's been not the most ideal. We've seen some idiosyncratic moves. I mean, taxable munis, which I would say have been better value and better credit quality than investment grade corporates, have performed very poorly. And that's more of a liquidity issue. But at the end of the day, if we're buying bonds that are individual bonds, we're going to get that money back. So it's almost a bend and not break strategy, which in the sense that you'll lose principal value, but you know, as the bond rolls down the yield curve, you will get back. If you're owning individual bonds, that's always the case. You know, knock on wood, pending no defaults. But if you're in a mutual fund, you don't really have the rights there. You have the right to cash flows based on somebody else's decisions. You don't own anything. And they're not going to hold those bonds to maturity because they want to have a constant duration and constant credit quality. If things change, they're just going to be buying and selling. You eat the tax, you know, based on whatever they decide. So I think to Andrew's point, individual bonds is the way to go right now. I think we're heading into a stock picking market and a bond picking market, which has not necessarily been the case in the the ZIRP and NERP era, zero interest rate policy or negative interest rate policy. But it's been very choppy and things have been really idiosyncratic. I mean, talking about floating rate instruments, floating rate munis have performed like a dream. Floating rate preferred stocks have performed like a nightmare. Even though the coupons continue to go up and up and up with the rates, the principal values are eroding very quickly because they trade more like stocks than they do like bonds. And so that's been a little bit of a thorn in my side as well. But I do feel confident that as interest rates go up, you're going to get more and more income off those things and they're going to perform. And some eyeballs are going to get to them and suddenly they're going to reprice the upside. But it has been a tough year. Fixed income has had the worst year in 40. So it's been an interesting year for sure.
Last question. Can you elaborate on Costco's 20% return on invested capital?
Yeah, I mean, that's, so basically what Costco does is
Explain return on invested capital. That's what they're getting at.
return on invested capital is simply the capital expenditures that a company makes. And then the incremental net income that you can make from that. And so basically, if I were to go to Costco and say, here's $100, come back to me a year and show me what you have, Costco would come back and say, here's $120. That's what they've done for the last 5 years. And we think they're going to continue to do that going forward.
Yeah, and the other piece on Costco, we didn't hammer this on the presentation. The thing we love about Costco is if we put up their margin year by year over the last 10, 15, 20 years, nobody in this room would be able to say, hey, that year is 2008. That year's 2009, challenging periods. They're so consistent in their management. That's a big piece of what we're looking for. Reliable revenue, controllable margins. When you have that and you have a period like we've had with some multiple expression stocks are apparently cheap, as one of the charts showed previously, when you have that, that puts you in a position that when things return to normal and the market psyche starts valuing things differently, you're in a good spot. You're not digging out of a hole. Any other questions just live from the room?
The strong dollar, how does it affect the U.S. multinationals? Therefore, how does it affect your portfolio?
Great question. It was great for us personally. When we went to Ben's wedding, I mean, it's like 12-course dinner for $12, like pretty sweet deal. Tom got a whole wardrobe for like $200.
Yeah, I lost my bags. I got a full suit, shoes, belt, 2 dress shirts, tie, and undergarments for like $200. Awesome.
Yeah.
But
I remember.
Yeah, and he looks great,
I
right?
told everybody that. Probably talked about it.
Well, I appreciate the setup because you gave me the chance to make my best in-office joke, but when I studied at Wharton, which was for 2 days for a conference, when I studied at Wharton, there was a hedge fund manager that spoke, and he talked a lot about what can actually generate measurable and predictable outperformance for a portfolio. And he listed 12 different factors. It was strategy, turnover rate, type of companies they were investing in, all of these things. Number 12 was currency. It will have an impact. To sit here and say we figured it all out would be a falsehood. No one can really effectively hedge against the swings in currency. It will have an impact. I mean, you think about some of the companies that we own in the portfolio that are very global. It's going to be a challenge. I don't know if you have anything specifically, Ben, but the biggest answer, I mean, I would give you is we're kind of along for the ride. You know, the thesis of that presentation was don't make decisions based on this, either to buy or to short, to sell, whatever it may be. Buy high conviction companies in which you have a real thesis that's defensible regardless of currency headwinds. So to an extent, we're not hyper focused on it. We have Harrison did some work actually looking at some currency plays in emerging markets where we thought, hey, maybe this would look attractive, maybe not even necessarily individual companies, but let's find a really good emerging market manager that is going to be exposed to one, commodities that have potential mispricing, but two, some currency, tailwinds that could help us out. And ultimately, we struggled to really find one that we really discerned as, hey, this is an attractive businessman's risk. Let's jump in. I don't know if you have anything you'd add.
Yeah, a couple specific anecdotes. The companies that are really getting hit are those tech companies. Because a lot of them have revenue outside the country with a cost base inside the country. And I think that's the key distinction. Procter & Gamble definitely gets hit from currency. It's to the tune of about 3 to 4 points. But a lot of their cost base, their manufacturing is close to their actual sales. So you can kind of maintain margin just a little bit. Maybe your overall numbers gross down a little bit, but your margin remains relatively constant. Where the companies that really get hit are the Googles, the Facebooks. Those companies have both been hit high single digits in terms of revenue as a result of all this. Salesforce was the big canary in the coal mine back in June, but a lot of the other companies are following suit. And so that's definitely something we're wary of. On the flip side, there's also kind of an opportunity for companies with a cost base in Europe, for example, that sell into the US. One company that's in our portfolios is Diageo, Guinness, Bullet Rye, couple tequila brands, very diversified alcohol company. And we think that they actually may have an advantage position because of their currency.
But yeah, to my earlier point, more so we like it because we like to have drinks.
Yeah.
Anything else? Awesome. Well, if you have questions, come see us. We appreciate you guys. Thanks for being here. Thanks for everybody on Zoom. We will be back January somewhere. This worked out well. We will probably send out a survey. John does a good job. We try to get feedback from everybody. That's why we had a slightly shorter presentation and changed up the Q&A a little bit. If you get the survey, please respond. That is really helpful to us. I mean, we talk about this a lot. I think when we talk about the customization aspect of our company, most people think portfolios. We also mean communication. If you make the effort to show up and listen to some boring people talk about the market and the economy, like, we want to give you what you want. So please take 3 minutes to fill out the survey. It's usually like 5 questions. That would be very, very helpful to us as we kind of adjust everything from location to length to content, Q&A formats, all that stuff. That's very, very helpful to us. With that, we'll close it up. Thanks, guys.
What is it?